everyone. They told me to be loud, so I'm not sure if I'm loud enough. All okay. All right. It's a pleasure for me to be here with you today. I'm Mazen Abou Ismail, market analyst at Naqdi. So let's talk about what's happening in the financial market today. So we are living in a trade war where the biggest two economies after April 2nd, President Trump announced aggressive tariffs, quickly followed by retaliation from China and other countries. So this tit for tat increased the risk of higher inflation and slowed the global growth, which triggered the sell-off. And of course, in each storm, there's a safe place. So the gold reached 3,500. If we look closer to the daily increase, we can see that in some days, the gold increased $100 or $120. For the context, gold moved like $30 to $40 per day. So this spike in the price is what we call volatility. And here's the thing. Traders and market participants fear the volatility. And in investing, there's no free lunch. So we need to go outside our comfort zone. And I'm here today to walk you through the three steps of how to ride the storm and turn volatility into opportunity. Because when you embrace the volatility, you can stay ahead while others panic. Okay, the VIX index, I wasn't expecting, by the way, the screen so big. So when I trained, the screen was smaller. So bear with me. Okay, so the VIX index, which is also called the market sentiment indicator. So it simply can tell us if the market is calm or stressed or panic. So whenever it's below 25, the market is calm. And when we go down, it's calmer. When we go up, it's more panic and more stress. So on April 7, this is when the market participant struggled to assess the impact of new tariffs. The VIX spiked to 60. We have seen these levels 5 times during the 35 years. As we can see here, we see extreme spike in October 2008 during the financial recession and during the pandemic. So high VIX, meaning high fear, prices down, market at bottom, which gives a rare opportunities to enter the market. So what's happening here, which is currently, we have fear in the market, high volatility. So it's the same thing. It gives us a positive outlook and an opportunity to enter the market. So high VIX, fear, sell-off. Later on, the liquidity will come in, market rebound. So this is how volatility is an opportunity. Since 1950, the market has seen dozens of crises, from a Vietnam War to dot-com bubble, September 11, and the latest reciprocal tariffs. So here we can see the S&P 500 with dips above more than 15%. So many times, the S&P went down more than 15%. Sometimes it reached 57%. And what happened after? The market not only rebound, it surged. And the S&P 500 delivered average return of 10% yearly. Dips is, or what felt as a dip at the end of the word, later on was an opportunity. So volatility, again, is an opportunity to enter the market. Okay, so volatility is not the enemy, it's the opportunity, and here is why. It reveals mispricing, like it shows gaps between the intrinsic value and the market value, the real value of the asset and the current value, which gives us or offer us an entry point at a discount. And if we're already invested in the market, it tests strategy discipline. So if we are already invested, we stay in the market for not to miss out the rebound later on. So volatility isn't just risk, it's hidden reward with timing. Okay, so let's explore what's trigger volatility. I guess I missed a slide. Let me just check. Okay, I'm good. So I just wanted to add something here that the market is always crashing, as we can see here, and always recovering. So volatility, crash, and then recovering. This is what history told us. Okay, so let's explore what triggers volatility. So volatility is any change in the expectation of the market participant due to shock or surprise. And those surprises can be macroeconomic surprise, like change in interest rate, change in inflation. So like what happened now, the Fed fund, the central bank in US, was about to decrease interest rate, but then he paused, and with the last speech of the chair of Fed fund, he said that he will pause and wait and see. So this triggers volatility. Also, the political and geopolitical shocks, the trade war that we are living in now, triggers volatility, and as well the macro economics and earnings. So when we had financial crisis into the banking crisis in 2008, or any earnings surprise when market participants expect a better earnings from the company, but they missed it, the company missed it, this is trigger volatility. So any event affecting the confidence of the market participant will trigger volatility. So let's see how we can anticipate the volatility. Economic calendar is your radar, so you have to know when is the major data release or the Fed or the central bank scheduled. Usually the volatility will happen before or after those dates. The VIX index, so which measure the sentiment in the market, whenever it's above 25, there's panic, there's risk. Whenever it's below, so the market is calmer. And also the news sentiment, or nowadays with Trump, with one post on social media can move trillions. Okay, so how to capitalize on volatility, or how to have a plan to benefit from this volatility. So let's break it down between two paths depending on your strategy, if you're looking for long-term or short-term. If you're looking for long-term investment, you can divide your investment into tranches. So you buy, if the price went down, you buy again, and then you wait until the market go up. So here you are averaging down your cost. This is the dollar cost averaging. And even you can use it even if there's no volatility. You can buy a specific amount each month, let's say. So if the market go up, your value of your investment is increasing. If the market go down, you buy again. And in this way, you're decreasing your cost. And when the market go up, you're making profit. Okay, continuing with how to benefit from volatility, we can use a technical analysis method, which is spotting bullish and bearish signals. So the idea here is to buy above the 200 days moving average. So bullish trend is meaning when the price is going up. Bearish is when the price is going down. So using the 50-day moving average and 200-day moving average, when the price is below the 200-day moving average, meaning we are in a bearish, and this one, the 50 and the 200 lines cross, this is we are in a death zone. So Apple, for instance, Apple is in the death zone, meaning the prices are below the 200 average, and it's in a bearish signal. So again, the idea here is to wait until the price is above the 200-day. So we are in a bearish, so we enter the market. If you're a day trader, you can trade with trend. You can use wider stop loss because the price is volatile, go up and down a lot. And of course, use smaller size to manage your risk. And in addition to trade after a confirmation like the 200-day moving average. So zoom out, plan, and wait for the confirmation and enter the market. So I wanted to add something as well. It's not about waiting for the perfect moment. It's a train for the storm and stay ahead. So if you want to ride the storm, we at Naqdi, we're ready to help you. We are an online brokerage company with 17 years of experience. We provide access to more than 15,000 on products from Forex, gold, silver, oil, stocks, and indices. We operate under STP, straight through processing model, where we're not a market maker. There is no human intervention. Each order will go directly to the market. And of course, we are licensed by many entities. One of them is Securities and Commodities Authority in UAE. Thank you so much, and hope to see you again.